Does your startup need money? Well, venture capital may be the right way to go. In this video, I'll tell you what you need to do to get funded by a VC and the specific strategy that may be the best way to maximize both your time and company value. The first thing you need to decide is if you really want to raise venture capital. And let's be honest, there's a 97% chance that it's not the right path for you and your business. In fact, it's probably even higher than that. It's probably like 98.5%, because today, less than 3% of all companies are funded by venture capitalists. And if you think about it even further, there's a lot of those businesses that probably shouldn't be funded by venture capitalists. So it's a really small percentage. You should be asking yourself questions like, can your business scale to $100 million in revenue plus and be valued over $1 billion or not? Can you build that kind of scale? You have to ask yourself if you're going to be comfortable owning less than 10 to 15% of your business by the time it gets acquired or goes public. Are you going to be okay giving up that level of control? Are you going to be willing to constantly be selling to employees, selling to customers, and selling to venture capitalists for more capital? Because once you're on the venture capital drug, it's so hard to get off because every venture capitalist is pushing you towards a bigger and bigger outcome because that's what they need in order to generate the returns for their investors. And so they give you a bunch of money and then tell you grow, 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 so that then the next venture investor will value you higher, and then they're going to put more money in and they're going to tell you, guess what? Grow, grow, grow. Got to grow that valuation as high as possible. So by the time you get acquired, you end up owning very little of the business, but hopefully it's worth a lot, so that the venture capitalists can generate a good return and keep their business going. Because that's, as venture capitalists, how we keep our lights on and keep operating. We got to show good returns so that investors will invest in our fund and give us the opportunity to keep investing in businesses in the future. So if I haven't scared you away yet, then the next question you have to ask yourself kind of goes back to that first question, which is, does your company have the ability to scale? Does it have the ability to become a dominant monopolistic entity in your market? Now, I know monopoly is monopolistic. It sounds like such a dirty word, but the reality is all the best venture-backed companies ultimately are monopolies. You don't think Amazon's a monopoly. You don't think Google's a monopoly. You don't think that Facebook is a monopoly. You don't think Apple is a monopoly. They are all monopolies. Now, they may not be pure monopolies in that like every single person has to use an Apple computer, but they definitely have monopolistic tendencies. That ultimately is like what allows them to become really big and really profitable. And so as a venture capitalist, you're looking for businesses that can become monopolies, that can carve out a market and own it. Because if you can do that, then you can charge higher prices than normal. And those higher prices allow you to capture more profits. And that makes your company more valuable, the more profits that it's generating. So you have to ask yourself, can your company achieve that? Well, not every company can. If you're building a software business, software businesses receive a lot of venture capital because they are highly scalable. Once I write the software, it doesn't matter if I sell it to one person or a million people. It basically costs me the same amount to sell it to one versus a million. It's just some extra server costs because I already did the hard work of writing the software. And so software ends up becoming very scalable. And so if I can build software that solves a pain point for a very large market, and I can do that better than other people can, then that can open up a huge opportunity for me and I can build a really big business. If, for example, I'm able to tap into some sort of network effects or like marketplaces. So you think like Uber and DoorDash and Lyft and some of these marketplace companies, those can be really interesting because they can be really hard to start because I got this chicken and the egg problem, right? Do I get drivers or I get passengers first? But the flip side is once I've got that and it's going and growing, then I get to tap into these like network effects where like the marketplace gets better and stronger as more people enter and more valuable for all parties that participate. And then it becomes super hard to displace them. I mean, as much as people like to moan and complain about Facebook, the reality is everybody's on Facebook or Instagram or WhatsApp or one of the properties they own because everybody's on those. And it becomes really hard for an upstart to come around and pull them off. I mean, I think TikTok's done a phenomenal job, but they are still a relatively small player in comparison to Facebook in terms of users and user engagement and growth and so on and so forth. And so, you got to be thinking about your business. Like, is it really scalable? If you're selling a consumer product, that's going to be probably tough to scale and get to be something that's really big. Now, there are venture investors that will invest in consumer products businesses, but there are a lot fewer that invest in that than invest in technology and software, for example. Another area that's pretty interesting is fintech. Although in the recent market, fintech has taken a huge beating, nonetheless, fintech is basically just software plus money. So again, think about your business and what are the things that would make it attractive to VC. And the big things are, from my perspective, you operate in a huge market. You have the ability to grow very quickly and scalable and efficiently. And you're able to carve out some unique competitive advantage that keeps others from replicating what you do or getting access to your customers. All right, let's talk about the different stages of venture funding. So the first one is generally like pre-seed and seed. Pre-seed is pre-product for the most part. Seed is post-product. So pre-seed is like friends, family, fools, angels, your own money, the home equity line that you pulled out of your house, whatever it is to help get that initial capital to build the product. Once you've built the product, then you can go and raise seed money. That seed money is all about helping you get product market fit. And product market fit is basically this idea that you have refined your product to a point that it is attractive to a very large market. And when I say attractive, like customers are kind of beating down your door to get access to it. Once you've achieved product market fit, then you would raise traditional venture capital like a Series A, Series B. Those rounds of funding are designed to provide you with the capital to build out your sales and marketing motions. That money should help you build out a sales team, build out a marketing organization, devise your sales strategy and marketing strategy, and hopefully start creating some consistency and repeatability about how you sell the product. You should be developing strong growth metrics and sales efficiency metrics that demonstrate that you're able to do it efficiently. Things like the rule of 40 or magic number, having good CAC to LTV ratios. A lot of those things are really important and helpful to demonstrating to venture capitalists that you have figured out how to sell your product. Once you've figured out how to sell your product, then it's all about scaling the business. And Series B and beyond is all about investors coming in and providing capital to help you put more money into your sales and marketing organizations while simultaneously ensuring the product can hold its own and grow the business and get it to the point that the company can be acquired or go public for ideally hundreds of millions, if not billions of dollars. At that point, you may decide to raise money from public investors in order to continue to put fuel on the fire and continue to grow and acquire market share. Or you may use that money to go and acquire competitors or smaller businesses as another way to gain market share. And lastly, you might use that money to further expand and deploy new products or services into new markets, leveraging kind of your current platform in order to do that. Okay, so that's kind of the general life cycle. How do you attract VCs? Well, here's the thing. Venture capitalists, we're kind of like lemmings, right? We're all going to jump off the cliff together. But in all seriousness, as much as we VCs love to say that, we love disruptive technology and we're contrarian investors and so on and so forth, I think, one of the investors I really like said it best. I think it was Bill Gurley that said it best, where he's like, it's good to be contrarian, but it's better to be right. And so sometimes as a VC, you have this tension where it's like, yeah, I want to back the next big thing because the next big thing has the biggest potential to generate, to become a huge business and totally revolutionize and disrupt, the world and make the world hopefully a better place. And by doing so, I'll make a ton of money. But the flip side is very few funds, if any funds, have enough resources to help companies achieve that outcome. They all need to partner with each other, at least to some degree. I don't know of a single seed stage fund, even the ones that are really big, that can fund a business all the way from the day that they start selling the product all the way to the time they get acquired or go public and are worth billions of dollars. You need other investors to come in and help, and you want other investors to come in and help along the way. But what that means is that you start to find yourself kind of watching what other people think and depending on their decisions as well. And so sure, some of it is because VCs to an extent can be a little gutless, but there's also an element of you got to have people, you got to have friends around the table if you want to build something big. And that's just the reality. So here's my tip if you want to build FOMO and get VCs excited about your deal. And that is to basically play VCs off of each other with this whole lemming effect. You never want to lie. You never want to hide things. But that doesn't mean that you always have to be 100% upfront with every little thing that might be bad with your business, or be fully transparent all the time. It's not like VCs are going to be transparent on their side either, right? They have a ton of knowledge. They do deals like this all the time, a lot more frequently than entrepreneurs do. And so, there's a little bit of asymmetry here. Play it to your advantage where you can. So one of the things that I recommend to a lot of entrepreneurs that they do is this tier 1, tier 2, tier 3 strategy. So in the tier 1, 2, 3 strategy, what you do is you go to tier 1 venture capitalists. These are like your dream VCs that you would love to have invest in your company. And you don't pitch them. You just ask them for advice. And once you get their advice and you have some meetings, then you go to your tier 2. These would be the funds that you would be happy with, but they're not your dream VC. Pitch to them. And you can kind of use the fact that you just went and talked to a bunch of tier 1 VCs to talk to the tier 2. So you're like, hey, I just had a great meeting with Sequoia. I'd love to tell you about our business. And there's a good chance that they'll be like, well, if Sequoia met with them, there must be something interesting here. I guess I better take a meeting with them. And then once you've met with them, immediately go and meet with your tier 3 VCs. These are the ones that could definitely fund your business, but aren't at the top of your list. What you then want to do is you want to get these tier 3 VCs to issue a term sheet. And you can basically say, hey, I've been having great conversations with these tier 1 and tier 2 VCs, love to have you in the deal, but things are moving quickly, right? So you're keeping this momentum going, and hopefully you can get a term sheet from one of these tier 3s. You then use that momentum from tier 3 to push tier 2, and then ultimately go back to tier 1 and say, hey, I've got a lot of interest from all these different funds. Let me know if you think this would be an interesting opportunity for you to invest in. And what you find is as if you're able to create this momentum and get a lot of people interested in what you're doing and catch your vision and build conviction and start issuing term sheets, then you'll start getting to a point where you're getting the valuation you want, the deal that you want, and the venture investor that you want, which is important. The other thing is you need to be building these relationships ASAP. Whether those relationships are directly with the venture capitalist themselves, or, and then sometimes this is even better, building a relationship with people that are friends with the venture capitalist, people that venture capitalist knows and respects, because what that does is it gives you additional social proof. Even if you know the VC personally, to some degree, it may still be valuable to have one of their friends that they like and trust even more than you make that introduction to you, or at least put in a good word on your behalf, because that social proof can go a long way. Anyways, I hope that was helpful as you're thinking about whether or not venture capital is the right path for you or not. There's no shame of acknowledging that maybe venture capital isn't the right route for you. In fact, that's the same conclusion that 97% of other companies come to. And that's okay. But if it is the right path for you, then hopefully this content has been helpful. If you've enjoyed this, check out How to Start a Private Equity Firm with No Money. I think you'll find that I have an interesting take on how private equity funds can get started with no money. Thanks.